Good evening. Welcome to this live session from YouTube on startup investment in Canada from Quebec Japan Business Forum's newest YouTube channel. We are live, and it's a real pleasure to have many of you join us live tonight. I will begin with a quick word in Japanese so as to set the table for our international viewers. 皆様、本日は YouTube オンラインセミナーにご参加いただきありがとうございます。ケベック日本ビジネスフォーラムは日本企業向けにカナダにおけるスタートアップ投資に関するセミナーを英語でお届けします。ゲスト講師のジョナサン・ライゼン氏は、カナダで名高いファスケン法律事務所の弁護士です。ファスケンは、フォーラムのプラチナメンバーでもあり、本日のイベント開催もサポートしていただいています。この場を借りてお礼申し上げます。So thank you to Fasken, a platinum member of the Quebec Japan Business Forum, to join us tonight for this session. It's a real pleasure to have Jonathan Raizenne, who's a lawyer at Fasken, specializing in merger and acquisition in the field of technology, join us tonight. Jonathan, how are you?
I'm great. Thanks, Philip.
So yes, hopefully it's not too late with the family, but thank you for taking some time to connect live with our Japan viewers.
It's my pleasure.
Quick word on the Quebec Japan Business Forum. We are a private not-for-profit established in 1987. Our main mission is to foster economic and investment relationship between both nations. We are both a gateway and a facilitator for the business communities, and as well a growing number of businesses, service firms, and professionals alike joining the movement in building a greater and stronger relationship between Quebec and Japan. If you have not done so yet, please click and subscribe to the new channel, as more and more content will be built upon in order to provide meaningful opportunities for both communities to connect with one another. So without further ado, it's a real pleasure to introduce Jonathan, who, as I said, is a lawyer at Fasken. Fasken is a world-renowned law firm, and by a great length, the firm with one of the strongest image and reputation within Canada. So it's a real pleasure to have them join us tonight for the session. Jonathan, please, the floor is yours.
Thank you, André-Philippe, and thanks everyone for joining. Really happy to be presenting tonight and talking a bit more about my practice, about startup investment and venture capital investment in Canada. André-Philippe already introduced me, but I'm going to, I guess, give you a little bit more detail on who I am. So I joined Fasken in 2020 and I've been working in the emerging technology group ever since. Previously, I worked in-house at a local technology company here in Montreal, where I got a sense of what it really was like to work in a startup environment. And that company was also venture capital backed as well. So gave me an idea of what that type of environment is as well. And so my day-to-day is really, counseling startups with respect to initial incorporation and structuring, and, throughout financing rounds with VCs. We also do quite a bit of investor side work as well. So I'm happy to be able to discuss some of those points tonight. So let me just switch the slide. Right. Okay. I'm sorry. It seems that the pictures on my presentation are a little bit skewed. I'll try to go around that. Quickly about Fasken itself, as André-Philippe mentioned, we are, in fact, we are the largest law firm in Canada in terms of numbers of lawyers. We have presence in South Africa, in London, China as well, and also a representative in Tokyo. And so our emerging technology group, so those lawyers who counsel startups and VCs in the tech ecosystem, we do have the largest group in Canada as well, over 80 professionals that are dedicated to this practice area. And we assist clients in all sorts of different legal matters. We see our group kind of in different, I would say, three main pillars. Everything that's kind of corporate VC governance on one side, which is my specialty. We have folks that are specialized in IP and IP strategy, so helping startups determine what kinds of protections they need for their intellectual property. And then, privacy and data security is also another kind of pillar that we tend to provide a lot of advice in as well. And it's also a very hot topic nowadays in the legal field. So, we're there to help startups really throughout their entire company lifecycle, and also to support investors in their diligence and their investment process into those companies. So this is just a sampling of some of the clients that we work with that are based out of Japan, just to give you an idea of the type of scope of our client base. We help them with all aspects of their operations within Canada. So investment needs, mergers and acquisitions activity, IP matters, for example, folks who are looking to obtain patents in Canada, we can certainly help with that. And definitely happy to work with folks out of Japan. So to give you an idea of the agenda tonight, the presentation is called Start Investments in Canada, Understand the Market, Close the Deal. So it made it pretty simple, I think, to split out the different aspects of what I'm going to speak about tonight. The first part, understanding the market. So I want to give you folks an overview of who are the typical actors in the kind of startup investment sphere, what kind of companies are prevalent in Canada, what kind of investors are active and at what stage. And we also have some data on foreign investment in Canada as well too that I'd like to share with you. Regulatory considerations. There are some particularities with respect to the startup investment landscape in Canada, and if some of you are interested in, exploring startup investment, these are some things that you might want to know. The other point, the seed and pre-seed year in review, I thought would be useful for those who are interested in more early stage companies. We can glance over it if we have time. There's some interesting data out of there. So that's for the market. And then second part, close the deal. This is going to focus more on actual practical considerations with respect to a startup investment, what kind of diligence questions you should be asking, what kind of financing vehicles are prevalent. So for example, are financing rounds done via share issuances, via other sorts of vehicles or instruments? We can talk about that, and additional elements to consider, such as board governance, vetoes, preemptive rights, and a bunch of other terms that we see pop up in these kinds of deals. So I'm told that there's going to be a question period at the end, but if anybody has any questions during the presentation, please feel free to write them in the comments in the chat, and I can respond to them as we go. So please do not hesitate to do that as well. Okay, part one, understand the market. Who are the actors? Okay, so I guess before I start, discussing what kind of companies are most prevalent here, a general note: the VC investment market in Canada, I would say since mid 2022, let's say until late 2022, and then throughout 2023, has been what we call a down cycle. We've been little bit of a market downturn. So there has not been as much VC activity as in previous years. One of the reasons for that is there has been historically high interest rates in Canada the last couple of years, and so that makes VC investment a little bit less attractive for, for example, pension funds or hedge funds that would invest in VC funds themselves. So there is a little bit less capital on the market right now for VCs to invest directly into startups. And so the result of that, unfortunately, has been several promising startups struggling to raise money, or even some of them shutting down completely. We've seen layoffs and kind of other negative repercussions of the current market, unfortunately. The good news is that we are now seeing more stability when it comes to interest rates in Canada, and there's rumors of interest rate cuts as well. So we do expect 2024 to kind of stabilize the market a little bit, and we do expect to see an uptick in terms of the amount of deals, the number of not just the amount of deals, but also the deal, the amount of funding in each of the deals. Not as high as what we saw in 2020 or 2021, more of a return to normalcy. But that is kind of the overall context of the data that you see in front of you. So what we have here is basically a listing of the most active cities and the most active industries in 2023 with respect to venture capital financing. So if you look at the industry on the left side of the screen, you see that ICT, so information, communications, and technology companies, which would include, artificial intelligence companies, Web3, gaming, SaaS, hardware, basically any sort of pure software company you can think of. They represent still nearly 50% of all transactions and over 50% of the actual funding amounts. So definitely this is the industry that continues to have a large, certainly the largest market share of VC funding right now in Canada, partly because AI is such a hot topic nowadays. But it's really not just because of that. It's just these are the types of transactions where we're seeing kind of consistent interest and returns on. Another interesting section that may be of interest to folks out in Japan is our life science practice. So this is nearly a quarter of all transactions and 16% of total funding. This is the second largest subgroup of financing activity in 2023. So companies specializing in medical devices, biotechnology, pharma, all these great industries making part of that. Then clean tech in third position, 11% of deals, 16% of total funding. One thing that is of interest, I think, is that we are seeing some emerging sectors coming out in Canada, such as agribusiness. We do have historically a fairly important agricultural industry in Canada, and so technologies and tools to assist in those industries are really coming to the forefront. And then women-led businesses, which is an interesting subset, where we're actually seeing funds, actual VC firms, and kind of fund envelopes and larger funds that are dedicated purely to supporting companies that have been created and are run by women. We're also seeing equivalent portfolios for companies led by people of color, by Indigenous peoples as well. So there's quite a large push in terms of kind of diversifying the network of founders that we have in Canada. And in terms of locations, Toronto, Montreal, Vancouver, these are the three main cities. Altogether, something like 85% of all transactions happen in these cities. Toronto definitely at the forefront, and it's been like that historically. So it's interesting because despite the size of Canada as a country, still most of the transactions are located in those three main cities. But we are seeing some other emerging markets. Kitchener-Waterloo has been progressively doing well, as Tetsunagi has commented in the chat. Calgary is also another interesting subset of the market that really has been progressing well, partly because of its connection to the oil and gas sector. So we're seeing a lot of clean tech initiatives coming out of Calgary, which is interesting as well. So yeah, it's been an interesting few years, and we're seeing we're starting to see a little bit of diversity in the market when it comes to that. In terms of investors, so it's I think what you would expect from any sort of VC ecosystem when the company is starting out as at the seed and the pre-seed level. The types of people that are investing in these are angel investors, friends and family as well will come in and kind of give a little bit of what we call quote unquote love money to the founders. Early stage VC companies are also pretty active at the seed and pre-seed stage. But what is interesting, at least, and I think is particular to Canada, is that we have governments coming in at the early stages. So we have, what we call crown corporations. So, government entities that are, or I should say corporations that are owned by the government that will, start investing in companies at the earliest stage and actually have specific programs where they will sometimes match earlier investments as well on predefined terms. So there's a lot of support there from the government at the seed and pre-seed level. As you see in Series A and B, and even Series C, mostly VC firms, you're starting to get some strategic investors here. So companies, well, I guess what we would call corporate VC. So companies who have a venture capital arm and are looking for businesses that will be complementary to their own, and so they would invest in those businesses and either profit on a return on the event of a liquidity event, but most likely the idea is to potentially scope out acquisition targets. So we're seeing strategic investors come in a little bit earlier nowadays to try to get their foot in the door at some of these startups and already kind of plant the seeds that they might potentially be the acquirer of the company. So that's been an interesting development in the market. And then government continuing to support Series A, Series B, later stage as well, with other strategic investors, VCs, and private equity. So yeah, I think the takeaway here for everyone is there is a strong prevalence of government funding, even at the seed and pre-seed stage. And a lot of these government entities actually have a mandate to invest in local companies to continue bolstering the local economy. So the availability of capital from government is quite is I would say quite a determining factor for the Canadian ecosystem. What that means, though, the result is that oftentimes the terms of the investment might be a little bit more conservative than what you used to see in the U.S. or even in other VC markets, England, Singapore, etc. And that's because governments, while they do have a mandate to invest in even at the earlier stages when it's a little bit risky, they're still dealing with public funds. So there is a certain amount of reticence, I would say, to accept to be on the same level as, let's say, U.S. VC funds who invest in those companies. So that is something that companies have to consider, and you folks as potential co-investors in a government-led round, I should say, should also be considering. I think for me, the result is that it underscores that even Canada is still, I would call, an emerging VC market, because we're so dependent on governments continuing to fund the market. I don't think that our native VC funds would be able to support the entire market themselves. We are seeing a lot of U.S. investors coming in, and again, government funding. If you look at the table that we've put here, it might be a little bit small, but the first two, BDC Capital and Investissement Québec, who represent a very large chunk of the number of rounds of the last year, those are all government. So BDC Capital is the investment branch of the Business Development Bank of Canada. Investissement Québec is the investment branch of the Quebec government. The fourth one, Export Development Canada, is also a crown corporation. So just in terms of the size of the rounds, like you could tell that the majority of the money is coming from government still. So yeah, good things to know for you folks who are interested in exploring the market. Next slide about foreign venture capital. So we do also get foreign VCs coming into Canada to invest in Canadian companies. As you might suspect, the United States is definitely the most active in Canada as compared to all other foreign investors. The likes of Techstars, Y Combinator, Andreessen Horowitz, a bunch of other well-established names in Silicon Valley will routinely come up to Canada to kind of scope out the next big thing north of the border. Europe is also, we're also seeing them come in, and Asia as well. It might be a little bit hard to tell from the graph, but the third line at the bottom there is Asian investment in the VC market in Canada. And so we're seeing kind of an upward trend, I guess I would say consistent upward trend from the Asian market. And Japan itself last year invested in 2 transactions in Canada. It is still on the low side, but it's on par with other, I would say, well-established VC ecosystems such as Singapore and Hong Kong. They both invested twice as well. So we're hoping to see, either stability there or a little bit more of upward momentum in the future. So that's a little bit of an overview of who are the players, what kind of investors, and what kind of companies are most prevalent in Canada. Now, I guess the most interesting part for me as a lawyer to explain to you folks are the regulatory considerations. So, what are the legal issues that a lot of investors come across who are not necessarily used to investing in Canada? The first one, the director residency requirements. It's more of a formality, to be honest. But essentially, if the Canadian company is incorporated at the federal level, there is a requirement that at least 25% of the members of the board of directors be resident Canadians. So that is, there are ways to get around it, but in a typical board setup, you'll have some founders on the board who are most likely Canadian residents, and then you might have some investor representatives there. So you just have to make sure that the number of investor representatives who are not Canadian residents, remains low enough so that you can, still achieve the 25% threshold of resident Canadians. That's not usually an issue that we see come across a whole lot, but it is something to be mindful of to ensure that the company remains compliant with corporate law. And one thing that I do want to talk about is the next point, the scientific research and experimental development tax credit regime. We will routinely call this the SR&ED credit regime, I should say. Essentially what these are is it's a way for the company to borrow against its tax credits to be received in the future for technology spend. And so the government will essentially advance you the money that you would normally get on tax credits at the end of the year so that you can make those expenditures. And so this is a regime, I guess, that's relied on heavily by a large amount of Canadian technology companies. So much so that if this program at some point was reformed or were reformed in a significant way or removed, I think you would see the end of a lot of technology companies who would just essentially not have enough money to ensure proper R&D development. So the issue here with foreign investment is that you can get a significantly higher yield on these tax credits if the company continues to be what we call a Canadian-controlled private corporation. So in other words, you have to make sure that the company is still controlled by Canadians for them to benefit from the high tax credits. And what we mean by controlled by Canadians, it essentially means at the board level who can make the decisions and whether those people are either Canadian or appointed to the board by Canadian investors. And so sometimes when you get companies who have done a few financing rounds, have a few, let's say, U.S. investors involved, who start to take a larger position in the company and start to be able to, elect the majority of the board, let's say, or start also to have a majority of the outstanding shares, then you can be in a situation where the company loses its CCPC status. And so they effectively lose the majority of their tax credits under this program. So you'll often see more of a balancing act between foreign investment and maintaining CCPC status. There might be a situation where, I don't think anybody would necessarily refuse money from a foreign investor, but the control rights of that foreign investor, for example, a board seat, might not be as frequently given as if the investor was Canadian or if the round had happened a little bit earlier in the company's life cycle. And so investors can get comfortable with this. For example, if they Perhaps they would get a board observer instead of a board seat. They might get additional information rights. They might get additional shareholder veto rights. So there are ways around it that you can get creative and still retain a good amount of control over the company without necessarily affecting its CCPC status. But yeah, in a nutshell, this is one of the main issues I would say that comes up with startups accepting foreign investment. The Investment Canada Act is similar in a sense where it's a piece of legislation that essentially it essentially creates a protection against foreign interests purchasing voting control or majority stake of significant Canadian businesses. It might be a little bit less a little bit less pertinent, I should say, for those on the call today. But the idea is that if you're acquiring a voting control of a company with enterprise value of $1.3 billion Canadian, then there's a review process that is triggered. So the government essentially has to consent to that investment, whereas under that threshold, there wouldn't necessarily be that consent. I think actually, and it's funny because the thresholds actually do change depending on the country. I believe for Japan, it's something like 1.9 billion. So there are some countries that benefit from a higher threshold without necessarily triggering this review process. And also what's considered a voting control is also dependent on the context. In some situations, it can be as low as acquiring 33% of the company. So anyway, that's definitely something a little bit more complex and would probably merit its own webinar. So I won't get into it in too much detail, but there is we certainly are able to help with any questions on that. And then quickly, Quebec French language requirements. This might be more relevant to you folks if anybody is considering, creating, or I should say, creating a foothold in Quebec. So, opening an office here, for example, for scoping out potential investment opportunities. Essentially, if you have a Quebec business or a Quebec subsidiary or a Quebec office, depending on the number of employees you have, there might be specific French communication requirements that have your contract signed in French, and a few other things. This is something that's easy to navigate, but again, would require advice from Quebec local council. Okay, so I guess before we get on to the next section about actually closing the deal, I thought it'd be useful just to give you an idea of what's happening at the seed and pre-seed level, because that tends to inform later rounds of funding and I guess how companies are initially structured and how they get their initial investments. So what we're seeing at the earliest stages of startup investing is a shift towards using safes as investment vehicles. I'll get into what a safe is in the second part of the presentation. But suffice it to say, there's been a fairly significant increase where, in 2020, about a quarter of the rounds were structured via safe, and it went up to 50% by the end of 2023. So we're seeing a lot more of that vehicle. And the main reason, without getting too much detail, is it's a much more cost-effective and simpler standardized document than a convertible note or even issuing shares in the context of a funding round. So we are seeing a shift towards limiting the costs of financing rounds and trying to get them as efficient as possible. The second point, post-money safes becoming relevant. The post-money safe is without getting into too much detail again, essentially it contains a valuation cap that's based on the post-money valuation of the company. And the result is that the investor who invests via the safe is not affected by the dilution that is created from the conversion of these safes into shares at the next financing round. So the result for investors is if you invest on a post-money safe, it's easier for you to understand or to predict what your ownership in the company is going to be when the safes convert. So for example, if you invest $1 million in a company at a $10 million valuation cap on a post-money basis, then you just know you take 1 million divided by 10 and you know that you're going to own 10% of the company when the safes convert. Versus the pre-money formula, there's a little bit more uncertainty with respect to that. So we're seeing 86% versus 50% in 2020. Definitely the trend here is to go for the post-money safe instead of the pre-money safe. And then valuation, we'll talk about valuation cap in the next section, so I won't go too much into detail on this. But suffice it to say that the amounts, the size of the valuation cap really depends on the amount that the company is trying to raise. And so it essentially just proves that valuation caps are just pure investment or pure negotiation terms between the investors and the founders. They're not necessarily dependent on the company's actual value at that time. So yeah, we can I can answer any questions at the end of the presentation if anyone has any points on this. One other stat that I thought was interesting for last year in Canadian startup financing, valuation cap versus discount. So on the valuation cap, this is typically an investor-friendly term. And we actually saw a downturn in the amount of safes with valuation caps in 2023, which was surprising to me because the market wasn't particularly company friendly; it was much more investor friendly recently. So you would think that valuation caps would stick around because they are an investor-friendly term. But I suspect that the reason why there was a decrease in their popularity is simply because it's gotten even harder to determine what the correct valuation cap is because there's so much uncertainty in the market and so much uncertainty around valuing these early-stage startups. So investors might have been comfortable simply relying on a discount rate for their return. Okay, part two. So, part one really just was my attempt at explaining the high level overview of the Canadian market in terms of startup investment. Part two is really going to go into more details of what you should be considering if you are, in the process of analyzing a Canadian startup to invest in, or even in the process of actually closing a deal. So the first part that we typically would, assist in is on the due diligence front. So, essentially doing your research on the company that you're about to invest in. And typically this is done in a phased approach. So before a term sheet is signed, the term sheet is basically the document that sets out the terms and conditions of your investment in the company. There will be some diligence that a typical VC will do. And in Canada, what we see is the diligence is mostly on the financial basis. So they're looking at the financial statements of the company, seeing what kind of revenues it does generate, if any, and what the potential is. They're going to look at the product. They're going to conduct interviews with founders, most likely. They might even call some customers if the startup has customers at that point. But ultimately, it's more of a kind of a market analysis and a determination as to how that startup fits in the market and what its potential is within that market. And then once you get to the term sheet being signed, it's more of well, I shouldn't call it a commitment, but it's I would say a soft commitment that the investment's actually going to happen, because the standard in Canada is that most term sheets are non-binding. So, investors can still walk away from the investment even if they've signed a term sheet. And once you get to this stage of diligence, then you're really kind of, opening the hood of the company and reviewing all the legal stuff, the corporate minute books, large customer contracts, if there are any. You're going to look at potential IP issues. If there's any litigation, you're going to go into that as well. So you really kind of, cross the T's and dot the I's in the post-term sheet diligence. And this is typically where the lawyers will come in and kind of help with that process as well. So I just wanted to flag a few issues that are commonly raised during due diligence. The one that seems to happen all the time, especially at the earlier stages, is the absence or erroneous intellectual property assignment agreements that a company might have. So the concept in Canada with respect to IP is anything that you create as an individual. For example, if I work at a startup and I'm writing a line of code, that line of code, the IP behind that is owned by the author, so me in that situation. So if there's no express document in which I say, everything that I create in the context of my job is automatically transferred over to my employer, to the company, then if that document doesn't exist, then the company doesn't actually own the IP that I'm creating. So the document is what we would typically call an intellectual property assignment agreement. And the particularity in Canada is that it really has to be expressed. So you need that document signed by the employee as soon as they start in the company to ensure that the company actually owns all the IP that they're creating. So what we try to instill in our startups when we work with them from the very beginning is we will really ensure that that's part of their employee onboarding process. So an employee is going to sign an employment contract and they're going to sign an IP assignment contract automatically, because you don't want anybody, you don't want to forget anyone, because when you come to the financing round, and when you folks are, doing your diligence and realize that 3 people, for example, haven't properly signed this, well, maybe these people no longer work for the company. Maybe they're hard to reach. Maybe they were terminated and they don't want to sign anything for the company. So you might be in situations where it becomes very difficult for you to obtain the proper IP assignments. And in the worst scenarios, that means actually changing the product that you've been developing to kind of reinvent the portion that that person worked on, or even just pivot completely from that product itself, depending how much IP you're missing. So this is definitely a big one that we really try to flag as early as possible. Quickly, the missing documents on stock option grants. The issue here is that in Canada, for you to issue stock options to employees and for them to get the best tax treatment, your exercise price or your strike price for the options has to be equal to fair market value at the time of grant. So if I'm an employee at the startup and my employment agreement says, okay, you're going to get 100 options at $1 exercise price per option, and that those grants are never actually papered and never actually approved by the board of directors, then let's say I've worked for, I don't know, 2-3 years at the company, and essentially, they decide to paper it then, but perhaps the fair market value of the underlying shares has increased since then. Maybe it's $2 or $3 per share. So I can no longer benefit from the $1 exercise price. I'd have to, get the $2 or $3 exercise price because it just was never properly papered. So to ensure that the company's actually, doing right by its employees, you want to make sure that everything is done right when you're diligencing the company. I see there's a question from Helen in the chat. She asks, so you would recommend to have 2 distinct contracts for a new employee to sign, employment and IP assignment? I have seen just a clause in the employment contract. Yeah, so that also is another way of doing it. Typically, the IP assignment, at least in Canada, has there are a lot of elements to it, so you can include it in the actual employment contract if you wanted to. Just in terms of keeping the employment contract and the IP portion separate, we'll typically do 2, or even we'll do the employment contract and have the IP stuff as a schedule to it. That's also another way of doing it. But essentially, as long as the employee signs something that has an appropriate language, it doesn't really matter which document it's in. And then quickly on the rest of the diligence points, because I'm conscious of time. Third-party consents. So typically, if the company has any bank financing, for example, oftentimes the bank is going to have to consent to any change of ownership in the company. So that's just something to coordinate. And then employee claims, for example, it does happen quite a bit where, a co-founder will leave a business or might even be kicked out of a business before a financing round. You want to make sure that those that employee, that ex-employee, has signed all the required releases and other documents to make sure that they don't have any claims against the company. So different financing vehicles by stage. So I've split this out between the different, funding stages, pre-seed to Series C and above. In the pre-seed and seed round, you're going to see a lot more convertible instruments than you would in the other rounds. And the reason for that is because the convertible instruments are not they don't require the investors and the founders to agree on a valuation of the company. Essentially, the discussion for valuation is punted to the following financing round. So they're more cost efficient than going via the issuance of shares, because you don't have to negotiate a shareholders agreement, and there's a whole bunch of other steps that you get to skip. So definitely the preferred approach. We do sometimes see common share financings at the pre-seed level. This is typically if friends and family are involved and they don't really care about receiving preferred shares or, don't necessarily understand the intricacies of convertible instruments. But it is fairly rare, given the fact that, it would still be a share financing. So you do still have to determine the value of your company if you're going to issue the appropriate percentage of shares to the person. So definitely convertible instruments, the most appropriate. That said, as I put startup accelerators in the pre-seed section, for certain accelerators or incubators who decide to take a percentage ownership of the company as part of their accelerator package, we do see that in common shares quite a bit. And the reason for that is because they're not actually investing any money in the company. They're just basically saying that, it's the value of the service, it's the value of your inclusion in my startup accelerator program that justifies my purchase price. It's easier to kind of get around the valuation issue. So we do see it sometimes there, but it's more of a fringe scenario. Definitely convertible instruments, the way to go. And then Series A, B, C, this is really where you get into sophisticated VC, strategic investors, private equity sometimes, and they will insist on preferred shares. They really want to be shareholders of the company and have all the associated rights that we'll get into in just a little bit of the preferred shares. You might see convertible instruments between Series A, B, and C, and that would serve as kind of what we call bridge financing rounds. So when a company hasn't necessarily achieved all the milestones they think they need to raise the next, let's say, Series B round, but they need a little bit more money to get there, you might see a convertible note financing in between to kind of give them that boost. And the convertible notes would convert as part of the Series B financing in that case. So I'm going to kind of put safes and convertible notes together to give you an idea of what they are and how they work in Canada. And the next slide will be about preferred shares. So a safe and a convertible note. So a safe stands for a simple agreement for future equity. This is a document that was prepared by an accelerator in the US called the Y Combinator. And it's extremely popular in the US, very popular in Canada. It's, I believe, popular in Japan as well. I think there might even be a template safe prepared by the Japanese Venture Capital Association, the JVCA. Correct me if I'm wrong in the chat. But basically the idea behind this is, it's a document that you would subscribe to in exchange for money, and you wouldn't actually get shares of the company right away. You would get this safe that converts into shares at another event. And those events would typically be what we call a qualified financing. So the idea is, I pay today, I get my safe, and then at the company's next financing, where it issues shares and therefore has determined a valuation for it, that's when my safe will convert, and I will also get shares at that time. The advantage for me as an early investor is when I get those shares, I get them at a discount from a discount vis-a-vis the new investors coming in at that qualified financing round. So the discount is basically acts as my reward for having invested earlier and taking on more risk than investors in a future funding round. And so the way the discount works, it's either structured as a discount rate, which is what I was referring to in the previous slides before. So, for example, typical discount rates in Canada would range between, I would say, 15 to 25% of the price paid in the next financing round. So 20% is definitely, at least in my experience, what we see most often. So for example, if in your qualified financing round, the company is issuing shares at $5 a share, then my safe would convert at $4 a share. So for the same amount of money that I put in earlier, I'm getting more shares than the person putting in the same amount at the qualified financing round. So that's the way it works in the discount rate. The valuation cap is another way to get a good discount. And the way it works there is you're essentially predefining a maximum valuation that the safe would convert at. So for example, in my previous example, when I said, if you have a $10 million valuation cap, that means that no matter what happens in the future, assuming the company raises money at a higher valuation than 10 million, my safe would convert at 10 million. So in the situation where I have a $10 million valuation cap safe, and the company raises its next round at a $20 million valuation, that means I get an effective discount of 50% on the price per share. which can be huge, and definitely a very important motivating factor for investors to take the risk in investing in an early round. So that's kind of basically how they work. It's very similar to what you have in the U.S. Actually, it's exactly how it works in the U.S. And how it works in Japan, as far as I know. The convertible note is essentially, it works the same way in terms of the conversion. The difference with the convertible note is that it's a debt of the company. So think of it more of as a loan. So instead of me investing and receiving a safe, I'm actually receiving a promise from the company to reimburse me at some point. And if there's a conversion event before that reimbursement, well, then the amount that is owed to me is just converted into shares, just like a regular safe. So, the differences between safes and convertible notes, safe, I would say, is definitely more founder friendly. And the reason for that is, again, because it's not considered a debt, it's not a loan. So there is no reimbursement obligation at any point. The risk on the investor side is they could be trapped in that safe for much longer than they thought they would if there is no future financing of the company. And we do see it sometimes where the company raises an initial safe round and then starts getting a bunch of revenues coming in, things go well, and they realize, I don't think I need to raise another financing round. And so you have some investors that are kind of stuck in the safe, knowing that, it essentially either will never convert, or they have to wait until the company is sold before it converts, and they can, participate in the profits of the business. So that's the disadvantage for investors. It's an advantage for, founders, because they, it's a much simpler, it's a much simpler document, and they never have to think of the possibility that they might have to reimburse the amounts at some point. Now, the convertible note is the opposite. It's a debt. So there is the concept of a maturity date in the convertible note. Typically, it's 2 or 3 years after the investment is made. So in other words, if I'm an investor and I have, put in, $1 million in the company via convertible note, and there has not been a financing in the next 3 years, then I technically have the right to request reimbursement of my amount plus interest. So there's my return on investment right there. The problem with that is that most startups, at least venture-backed startups, will take that money and they're going to spend it right away on all their operating costs. So in 3 years, if they haven't raised another round, they might not even have enough money to reimburse the outstanding convertible note. So that's when you end up in a potential bankruptcy scenario with the company. So not as advantageous for founders, because they do have that maturity date kind of hanging over them, but it does give more security to investors because they know that at some point they would be able to request reimbursement. So I've given you a lot of details on how these things work. Suffice it to say, for someone who's looking at Canada as a potential market for VC investment, I think you think of it as a corollary to the US. We're heavily influenced by the NVCA and their documents and their way of doing things. So that's, if you understand the US market in terms of the investment vehicles, it should be similar for Canada. The preferred shares. So this is typically on the Series A, B, and C rounds, where all the safes, all the convertible notes convert, and everybody gets shares. New investors get shares as well. And they get what we call these preferred shares, which, as the name implies, have preferential treatment over the founder shares, the common shares. And that preferential treatment is what we refer to as the liquidation preference. This is a unique feature to, well, I shouldn't say unique. It's a very typical feature to VC-backed investment. The idea is that when the company is sold, the investor who has preferred shares has the right to either receive their liquidation preference, or they can receive the amount of the proceeds of the sale of the company that's equal to their ownership percentage. So if I'm an investor and I have 5% of the company shares, then I would be able to get 5% of the purchase price when the company is sold. The liquidation preference essentially protects them in the event that the company is sold at a much lower valuation than when they had initially invested. So if I invest, $1 million in the at a $50 million valuation of the company, and then it's later sold at $25 million, essentially means that my $1 million investment is now worth $500,000 if I, choose that path. The liquidation preference allows me to recoup that $1 million investment right away and not participate in the profits of the company. So it's a protection mechanism for investors to ensure that they're at least getting their money back if even if the company is sold at a lower profit. And so that means that, the consequence of that is that if all the investors, request to get their liquidation preference, there's a lot less money left over for distribution among the founders. So that's a scenario where the founders, even if they have, 50% of the company and it's sold at 25 million, they're not going to be getting $12.5 million in a distribution. They're probably going to get much less. So that's, I would say, the main feature. What we are seeing now with the new, with the latest market, as I mentioned, we're kind of going through a downturn. It's been a much more investor-friendly market. So we're seeing sometimes multiples on the liquidation preference. So instead of getting just your money back, you might be able to get 2 times your money back guaranteed, or 3 times, depending what kind of deal the company agreed to in your financing round. We're also seeing participating preferred shares, which basically combines both. So, how I mentioned before, where you either get the liquidation preference or you get the amount of the proceeds based on your percentage ownership. In this case, you would get both. So it would be something along the lines of the liquidation preference is paid out to all investors, and then whatever's left is not split between the founders; it's split between the founders and the investors. The investors get to double dip in the proceeds of the sale. So as you can see, there's a lot of protections in here to ensure that investors get a decent return. These are all, these all happen. I should say these are all useful in an event where the company is sold at a lower valuation than everybody thought. So if the company is a success, then none of this is really relevant. It's really just to protect them in the worst case scenario. One thing I do want to mention, because I'm conscious of time, we have about 8 minutes or so left. Yeah, thank you. Thank you for the comment. So one thing I do want to mention is the prevalence of this pay-to-play mechanism, which is coming back. I think we're seeing in more deals. The idea is that you want to force existing investors to participate in future rounds. And if they don't participate, their preferred shares get converted to founder shares. Typically, it was a company-friendly term, and it still is a company-friendly term. But we're seeing investors using it now to force other investors to reinvest in a business, because they know that without the reinvestment, the company will likely fail and they're going to lose their own investment. So we're seeing investors kind of using it to their own for their own benefit as well. So I just want to touch on quickly the last point here: additional elements to consider. We have a couple of minutes. Board governance, lead investors, so that the investors that are leading the financing round will typically require a board seat as a closing condition in Canadian deals. So, board governance is always an issue. You want to make sure you have a balanced board with representatives of the founders, representatives of the investors, independent directors as well, who have ideally deep knowledge of the industry in which the company evolves. So that's always a negotiation point. Veto rights. These are shareholder veto rights. So the idea that shareholders have to approve certain very important decisions in addition to the board approving them. So it gives shareholders an extra, an extra degree of control over what the company is doing. These are heavily negotiated as well. And then preemptive information rights. Preemptive essentially is the idea where you can get, you essentially get a priority to reinvest in the company in future rounds. And information rights is a standard, getting access to company financial statements, budget, cap table, a bunch of other things that you need to monitor your investment. So these are things that are quite frequent as well, and we see them in the U.S., we see them in Japan. So it's quite similar. I guess in terms of last remarks. If you understand the mechanics of an investment of a VC deal in Japan, you're likely going to understand how it works in Canada as well, with some particularities. So we're happy to help if there's any questions on that. And with that, I think I'll open up the floor. If there's any specific questions in the chat, please feel free. We have, I think, 5 minutes or so.
Wow, thank you, Jonathan, for such an informative session. Certainly, one of the best primer I've seen on venture capital investment in Canada, covering the whole Canadian regulation landscape, and certainly a good kind of a window open window into the kind of a more in-depth talk an investor could have with you in the office or over a call for specific deals. The floor is yours, chat. If you have questions you would like to raise, if not, I will break the ice. We have a few minutes, and I will not hold back. Jonathan, I want you to kind of put that presentation aside and talk to us about what you see right now in terms of we have how much demand from Japanese investors do you see in 2024 and beyond? Tetsunagi is actually stealing my question, so we'll answer his.
That's great. How much demand from Japanese investors do you see in 2024 and beyond? Does it look bleak with the weakening of the yen? Okay. Yeah, so I think we're still not seeing a whole lot of, well, I shouldn't say that. I would say that the interest that we're seeing in Canada from Japanese investors is typically from corporate VCs. So the large, like Sumitomo Mitsui, other large institutionals who have specific VC branches and are particularly interested in, I would say, clean technology, med tech, and energy. So oil and gas and
commodities,
energy commodities. So they are looking for specific startups to help them with their own goals. So it's a strategic investment for them. It's not necessarily, I want some sort of return. It's more, I want to invest in a startup that is developing something that can be used for my business. And so what we are seeing is these reverse pitch competitions that are being organized by Jetro, most notably, where instead of it being the companies who are pitching their companies to potential investors, it's investors who are pitching what they can offer and what kind of check size they can write to potential companies in the sectors they're looking for. So we are seeing that quite a bit. But in terms of let's say Japanese government or Japanese VC firms coming to Canada, for now it's still quite rare.
Yeah, I would point out on that for as well, Tetsunagi's sake. The large institutional investors have international cash flow in either USD, euros, and Canadian dollars, and they'll often just divest those cash flows and keep the yen just rolling internally, domestically. So we see a lot of companies with already internationalization branches to use those assets abroad, so as to kind of hedge against the weakening yen, which is a truth truly in this market. We are very conscious of time, and we'd like to thank you everyone to join us tonight for sure. Jonathan, I guess people can reach you at Raizenne@fasken.com. Yep. If you agree, we will include your information contacting our follow-up email so that everyone knows, it through one click they can join you. Thank you again to Fasken and Jonathan to partner with us for tonight's session. Thank you as well to Shoko Kai, the Montreal Chamber of Commerce for Japanese corporations, for their partnership as well and support into promoting the session within their own membership. Again, thank you all for joining us. We wish you a great day if you're in Japan, or a great evening if you're in Quebec. Stay tuned for more content from Quebec Japan Business Forum. Click and subscribe. I'm so excited that I can say that now. We hopefully will see you in the next session. Thank you, Jonathan. Thank you again.
Thanks, everyone. It was a pleasure.
See you.
Take care.